There is a particular kind of panic every trader knows. Not the panic of losing money, but the panic of watching money slip away without you. You're sitting in front of the screen. The S&P 500 melts upward in a straight line. Forex pairs burst out of consolidation. Gold breaks a level you've been watching for days. Crypto suddenly launches 20% in an hour. Your heart tightens. Your breathing shortens. Your mind starts whispering, "If I don't get in now, it's gone. Everyone else is profiting, except me. This is the move. This is the one. I can't miss this." That whisper becomes a pulse. That pulse becomes urgency. That urgency becomes panic. And with a single impulsive click, you abandon your system, your plan, your patience. All because the market made you feel like you were falling behind. That feeling has a name: FOMO, the fear of missing out. But in trading, FOMO is more than fear. It is a psychological storm, a cocktail of dopamine, desperation, illusion, and social comparison that pushes you to chase moves that are already gone and risks that no longer make sense. FOMO is the voice that says, if you wait, you lose. If you're disciplined, you'll be left behind. If you don't act immediately, the opportunity disappears forever. But here's the truth you rarely hear. The move is never the problem. Your psychology is. The market does not pressure you. You pressure yourself. The chart is not screaming at you. It is your mind that is screaming. And until you understand why FOMO grips you, why your biology turns urgency into impulse, why your cognitive biases distort reality in moments of acceleration, you will continue chasing trades that were never meant to be yours. This chapter is not about techniques alone. It is about transformation, understanding the triggers, rewiring the impulses, reframing the illusion of missing out. So let us begin with the truth behind FOMO and the path to freedom from it. You are learning trading psychology on the Winner's Mindset channel. If you see yourself in it, share your pain. We will solve it together. Before we can learn to avoid FOMO, we must understand what it truly is. Not the definition traders throw around on social media, but the biological mechanism underneath the feeling. Because FOMO is not a mindset flaw. It is not a weakness. It is not a lack of discipline. It is a neural response, a built-in psychological reflex that has existed in humans long before financial markets existed. To understand FOMO, you have to understand dopamine. Dopamine is not the chemical of pleasure. It is the chemical of anticipation, of potential, of the possibility that a reward is coming your way. And the moment the market makes a sudden move, a breakout, a spike, a trending candle, your brain fires a surge of dopamine not because you received a reward, but because you think you might be missing one. This is the neurological root of FOMO. Your brain reacts not to loss, but to potential rewards slipping away. In psychology, this is known as reward prediction error, the brain's reaction when reality gives you less reward than expected. You expected to catch the move. You expected to be prepared. You expected to be in the trade. You expected to profit. But you didn't. You're watching, not participating. The gap between expectation and reality creates a spike of neurological discomfort, and the brain hates discomfort. So it tries to close the gap by pushing you into action, any action, even irrational action. That's why FOMO feels urgent, why it feels like pressure, why it feels like the move will disappear forever if you don't jump now. It is not the market imposing urgency, it is your dopamine system screaming for resolution. And this brings us to the second driver of FOMO, the illusion of urgency. In nature, urgency keeps you alive. A predator approaches, act now. Food becomes available, take it now. Your tribe begins to move, follow now or be left behind. The human brain is wired to respond to now or never situations with immediate action. But markets are not predators. A breakout is not a life or death moment. a candle is not a threat. Yet your brain cannot distinguish financial urgency from biological urgency. So when you see a market move accelerating, your psychology interprets it as, "This is happening without you. You are being left behind. Act now or suffer." This reaction has nothing to do with strategy, nothing to do with system, nothing to do with logic. It is ancestral wiring being misapplied to a digital chart on a modern screen. And that brings us to the third element of FOMO, social comparison, the part most traders underestimate. Humans evolved in tribes. Belonging meant survival. Exclusion meant danger. Today, the tribe has changed. Twitter, Discord, Telegram, Reddit, CNBC. But the psychological mechanism is the same. When you see others winning, others celebrating gains, others catching a move you missed, your brain interprets this as, "You're falling behind the tribe. You must catch up." This comparative stress multiplies dopamine stress, and both multiply urgency stress. FOMO is not one emotion. It is three systems firing together. 1. Dopamine, anticipation of missed reward. 2. Urgency, biological pressure to act quickly. 3. Comparison, fear of being left behind. And when these systems overlap, they hijack your decision-making. This is why FOMO feels overwhelming. This is why it feels like you're losing time. This is why it feels like the move is slipping through your fingers. This is why logic suddenly disappears. Your brain is not reacting to the chart. It is reacting to an ancient survival system that mistakenly believes your well-being depends on chasing this move. Until you understand this, until you recognize that FOMO is a biological error, not a trading insight, you will always feel its pull. But once you see FOMO for what it is, once you understand the neurochemistry behind the panic, you can begin to separate yourself from it. Not by suppressing emotion, not by forcing discipline, but by learning to recognize the moment your brain tries to save you from a danger that doesn't actually exist. Not every market condition triggers FOMO. There are specific moments, specific behaviors, specific patterns in the market that light up the human brain like a fire alarm. Some markets whisper. Some markets drift. Some markets move in polite, measured steps. These do not create FOMO. FOMO comes from velocity, suddenness, acceleration, the feeling that this move wasn't supposed to happen, but it is. Let's break down the environments that trigger this psychological storm. 1. SP 500. Melt-ups. The SP 500 does not always move violently, but when it melts upward, straight, persistent, relentless, with barely any pullback, barely any hesitation, it creates a deep psychological disturbance. Why? Because the SP 500 is the safe index, the rational index, the slow index. So when it suddenly behaves like a rocket, every trader feels it. Wait, what's happening? Why wasn't I positioned for this? Is this the beginning of a major rally? Is this the move I will regret missing? This environment creates collective urgency. Momentum builds. Traders chase. Late entries pile on. Pullbacks shrink. Breakouts extend. This is prime FOMO territory. 2. Forex volatility spikes. Forex moves quietly until it doesn't. A sudden expansion of volatility on EUR/USD, GBP/USD, or USD/CHF feels like the market waking up. The trader's brain interprets sharp candles as signals of opportunity. This is where the money is flowing. This must be the start of something big. But in reality, Forex volatility often follows news. CPI, FOMC, NFP, interest rate projections, geopolitical shocks. These moves are often thin, illiquid, exaggerated, and they reverse just as violently as they appear. FOMO thrives on this kind of deception. You see momentum, you feel urgency, you enter emotionally, the move collapses, you get trapped. But the brain does not care. It only sees a fast-moving object and interprets it as danger of missing out. 3. Gold US dollar surges and reversals. Gold has its own gravitational pull in trading psychology. When XAUUSD runs, it runs with purpose. Fast, clean, emotional, dramatic. Gold is not unique, but its behavior produces a specific emotional signature. Sudden expansions, straight-line rallies, V-shaped reversals, manipulation around key levels, fear-driven spikes, safe haven flows. These characteristics create the illusion that a trader must act now, or the opportunity evaporates. This is why gold attracts both professionals and thrill seekers, not because it is magical, but because it stimulates the psychological centers of urgency, and traders mistake urgency for opportunity. 4. Crypto pumps. Crypto is the modern casino of FOMO. Bitcoin breaks $5,000 levels at a time. Ethereum pushes 8% in minutes. Altcoins explode 20%, 30%, even 100% in a single afternoon. Crypto pumps hit every FOMO trigger at once. High volatility, extreme acceleration, irrational optimism, community hype, social media reinforcement, stories of overnight millionaires. Crypto is where dopamine goes to binge. When an altcoin squeezes 40% in 2 hours, your brain does not care about risk. It cares about possibility. Possibility is the strongest drug in finance. Possibility is the foundation of FOMO. 5. News events, CPI, FOMC, NFP, earnings. Few things trigger FOMO more than news candles. Wild spikes, massive spreads, fake-outs, liquidation cascades, immediate reversals, thin liquidity pockets. The brain sees movement equals opportunity. The market sees movement equals risk. This mismatch creates disaster. News-driven FOMO is one of the fastest ways to destroy an account.
But traders chase anyway. Not because they are irrational, but because their dopamine system cannot resist velocity. The brain treats speed like scarcity, and scarcity feels like urgency. FOMO does not happen because you lack willpower. It happens because your mind is full of cognitive biases that distort your interpretation of market reality. Here are the most dangerous ones. 1. Availability bias. You overestimate the importance of information that is easy to see. A move that just happened feels more significant than one that never happened. Your brain screams, "Look at that candle! Something big is happening!" But the truth is, most big candles are just noise. Most breakouts are just reactions. Most pumps are just liquidity grabs. Availability bias exaggerates the meaning of the moment. 2. Recency bias. Whatever just happened feels like the new trend. If a market surges 2% in minutes, the brain assumes it will continue forever. Recency creates false confidence. False confidence creates impulsive entries. 3. Herd behavior. Humans follow groups. Markets amplify this instinct. You see traders celebrating gains online. You see green candles everywhere. You see hype, noise, excitement. Your brain says, if everyone is doing it, it must be right. But the herd is almost always late. The herd chases tops. The herd creates liquidity for institutions, and FOMO is the emotional engine of the herd. 4. Loss aversion, misapplied to opportunities. Loss aversion says you fear losing more than you enjoy winning. But with FOMO, loss aversion flips. You fear losing the chance more than you fear losing your money. This inversion is deadly. You chase the possibility and ignore the risk. You risk dollars to avoid emotional discomfort. 5. Narrative bias. Your mind creates stories. This is the beginning of a big trend.
Smart money is buying. This is my chance. I can't miss this. Again. Stories create emotional urgency that overrides logic. 6. Overconfidence. After missing a move. You miss one move, your ego feels threatened. You feel behind. So the brain compensates by pushing you to chase the next one. I won't miss this again. This overcompensation turns into reckless behavior, and the market punishes it instantly. Few emotions in trading are as powerful as the pain of watching a move happen without you. It feels unfair. It feels humiliating. It feels personal. But what you feel is not jealousy or greed, it is something deeper: fear of regret. Regret is a more powerful emotion than fear of loss. Humans will take enormous risks to avoid the future pain of what if. That is what FOMO is: a desperate attempt to avoid imagined regret. Your mind paints a picture. If you don't enter now, you will watch the chart go higher. You will hate yourself. You will feel behind again. You will feel stupid. You will feel slow. You will feel inferior. This imagined future creates real emotional pressure, so you enter. Not because it's right, but because doing nothing feels unbearable. You chase not the opportunity, but the relief. FOMO is not about wanting profit. It is about escaping emotional discomfort. FOMO trades are not just bad, they are destructive. They damage not only your account, but your psychology. Here are the invisible consequences. 1. Destroyed risk to reward. When you chase, you enter late. Late entries require wider stops. Wider stops destroy your expectancy. A trade with poor RR is not just bad, it is mathematically doomed. 2. Weak thesis equals emotional instability. A FOMO trade has no foundation, no plan, no reason, no structure. So every tick against you feels threatening. Without a thesis, your nervous system panics at the first sign of red. FOMO creates emotional fragility. 3. The emotional debt loop. You chase, you lose, you feel regret, you try to fix it, you chase again. This cycle compounds. The damage is not financial, it is psychological. You lose belief in your system, you lose belief in your patience, you lose belief in yourself. 4. Identity distortion. Every traded chased is a vote for the wrong identity: the impulsive trader, the insecure trader, the emotional trader, the reactive trader. Your identity shifts toward the version of you that acts without thought. And once identity shifts, behavior follows. This section is subtle but crucial. FOMO is universal, but certain environments magnify it. For many American traders, FOMO is intensified by cultural values. 1. The culture of speed. American society rewards fast results, fast decisions, fast success, fast action. This mindset conditions traders to equate speed with opportunity. 2. The opportunity narrative. From childhood, Americans hear, "Don't miss your chance. Strike while the iron is hot. Opportunities don't come twice." This internalizes urgency. It amplifies FOMO deeply. 3. Social media exposure. American trading communities are heavily intertwined with X, Twitter, Instagram, TikTok, Discord, Reddit, Telegram. Every platform becomes a mirror reflecting other traders' success and amplifying your sense of being left behind. 4. High leverage access. Forex and CFD brokers offer extreme leverage in the U.S. Leverage exaggerates volatility. Volatility creates dopamine. Dopamine creates FOMO. 5. The achievement mindset. American culture emphasizes winning, success, achievement, results. Missing a move feels like failure. Failure triggers FOMO. FOMO cannot be defeated by discipline alone. Discipline collapses under biological pressure. The key is to neutralize the emotional triggers before they activate. Here is how. 1. Train yourself to expect missing moves. Missing moves is not a failure. It is statistically inevitable. When you expect it, it no longer hurts you. 2. Build a missed moves journal. Write down moves you missed, why missing them was safe, how chasing them would have hurt you. This rewires your brain to associate missing with protection, not loss. 3. Practice dopamine delay. When you feel the urge to chase, wait 10 breaths. The chemical wave passes in under 30 seconds. FOMO is a neurological storm. Let it pass. 4. Develop a context-first mindset. Before entering a moving market, ask, where is price in the larger structure? Is this a sustainable move? Is this chasing? Do I have a plan? FOMO dies in the presence of context. 5. Replace urgency with expectancy. Say this aloud. If this move is real, there will be another entry. This statement kills urgency immediately. 6. Train the skill of stillness. Sit. Watch. Do nothing. The ability to not act when stimulated is one of the highest forms of trading mastery. Rules protect you when emotions attack you. Here are the protocols to prevent real-time FOMO. Protocol 1. The 30-second rule. When a candle surges, do nothing for 30 seconds. Your brain resets. The move clarifies. Your urgency dies. Protocol 2. The snapshot evaluation. Capture the chart in one mental snapshot. Is this late? Is this extended? Is this structure or emotion? The snapshot disrupts impulsive action. Protocol 3. The anti-chase statement. Say aloud, this move is gone. If it's legitimate, I will catch the next entry. This kills the illusion of scarcity. Protocol 4. The predefined entry model. Only enter if conditions match your written entry criteria. If the move does not match the model, it is not your trade. Protocol 5. The walk-away reset. If you feel the pull of FOMO, stand up, walk away, drink water, reset. Even 60 seconds breaks the loop. Protocol 6. The future self check-in. Ask, will my future self be proud that I chased this? If the answer is no, you know exactly what to do. FOMO thrives on one belief. If I miss this move, I am losing. This belief is wrong. It is toxic. It is the root of emotional trading. Here is the reframe. Missing a move is a form of discipline. Most moves are noise. Most breakouts fail. Most pumps reverse. Most volatility is manipulation. Professionals miss 80% of moves and still outperform the traders who chase everything. Because success does not come from capturing every move, but from capturing the right moves with the right risk at the right time. Missing is not losing. Missing is mastery. And now you understand the truth beneath the panic. FOMO is not the market calling to you. It is not opportunity slipping away. It is not destiny leaving without you. It is a lie, a psychological illusion, a trick of the nervous system. The move is never the enemy. Your desperation is. The market is never leaving without you. You are leaving yourself when you chase it. There will always be another move, another entry, another trend, another opportunity. But there will not always be another version of you who still believes he can trade with integrity. That version of you is worth protecting. Because trading is not a race. It is not a hunt. It is not a sprint to capture every candle. Trading is a practice of patience, restraint, clarity, discipline, and the quiet confidence that no move is worth losing your foundation. FOMO is the storm that tries to pull you away from the trader you want to become. Calm is the anchor that brings you back to yourself. So let the move go. Let the market run. Let others chase. Your moment will come, not when you react, but when you remain still long enough for the right opportunity to reach you. That is how traders evolve. That is how discipline is forged. That is how you become the trader you were meant to be.